For decades, the financial world has whispered a singular haunting mantra: sell in May and go away. This adage, rooted in the seasonal underperformance of the stock market during the summer months, suggests that investors should retreat to the sidelines until the cooler breeze of November arrives. Historically, trading volumes thinned as institutional giants vacationed in the Hamptons, leaving the markets vulnerable to volatility and stagnation. But as we stand in May 2026, the old guard is facing a paradigm shift that threatens to render this centuries-old wisdom obsolete. The traditional summer lull is being challenged by a relentless 24/7 digital economy that never sleeps, driven by algorithmic. In this brave new world, the $82,000 price floor of Bitcoin isn't just a number. It is a psychological fortress built on institutional conviction. While the ghost of 1929 and the echoes of 2008 suggest a seasonal retreat, the macro landscape of 2026 is fundamentally different. We are witnessing a decoupling where Bitcoin stability acts as a lighthouse for tech-heavy portfolios. The classic sell in May playbook assumes a lack of catalysts, yet the current environment is teeming with fiscal stimulus and technological breakthroughs. To walk away now is to ignore the structural transformation of the global monetary system. The question isn't whether the tradition exists, but whether it still applies to a market fueled by The primary driver behind this resilience is the liquidity pipeline, a massive unidirectional flow of capital from traditional finance into digital infrastructure. Unlike the retail-driven rallies of the past, the current influx is powered by pension funds, insurance giants, and sovereign wealth funds seeking refuge from fiat debasement. This institutional floor creates a buffer against the typical summer drawdown. When we analyze the sheer volume of assets being redirected, it becomes clear that the liquidity isn't just visiting, it's colonizing. These entities operate on multi-year time horizons, meaning their buy orders are programmatic and indifferent to seasonal clichés. This steady accumulation absorbs any minor selling pressure, preventing. Spot Bitcoin ETFs have transitioned from speculative novelties into core components of the modern balanced portfolio. In 2026, we are seeing the second-order effects of this integration: ETF velocity. Financial advisors across the globe are now mandated to include digital assets in their risk parity models, ensuring a constant stream of buy-side pressure regardless of the month on the calendar. This systemic inclusion means that every time the market dips, a buy-the-dip mechanism is automatically triggered by rebalancing protocols. This isn't just speculative fervor, it's a structural adjustment of global wealth. The sell-in-May strategy fails to account for this automated bid, which serves as a shock absorber against the macro headwinds that historically derailed the summer markets. Parallel to the rise of digital gold is the explosive growth of tech infrastructure, particularly in the realms of artificial intelligence and decentralized computing. The synergy between high-performance hardware and blockchain settlement layers is attracting billions in private equity. These investments aren't liquid, they are long-term bets on the foundational plumbing of the future economy. Because these funds are locked into multi-year development cycles, they provide a stabilizing weight to the tech indices. Investors who exit in May miss the crucial R&D milestones and hardware rollouts that typically occur during the mid-year conferences. The marriage of silicon and code has created a new asset class that thrives on innovation, a force. Furthermore, the geopolitical landscape of 2026 has introduced a new variable: sovereign adoption. Nation-states are increasingly viewing Bitcoin and strategic tech assets as essential components of their national reserves. When governments begin to accumulate, the concept of a trading season evaporates. These actors are playing a game of decades, not months. This sovereign hodling removes a significant portion of the circulating supply from the open market, exacerbating the supply-demand imbalance. As traditional currencies face inflationary pressures, the allure of fixed supply assets grows. This macroeconomic gravitational pull is so strong that it overrides the historical tendency for summer stagnation. We are no longer trading against human traders. As we enter the mid-year phase, the market often enters a volatility trap. This is a period of sideways movement and sharp, short-lived price swings designed to shake out weak hands. For the uninitiated, these fluctuations look like the beginning of a crash, triggering the sell in May impulse. However, a deeper look at on-chain data reveals that this is merely a distribution phase where impatient retail capital is transferred to patient institutional holders. Understanding the difference between a trend reversal and a natural consolidation is the hallmark of a professional investor. The noise of daily volatility is the camouflage used by smart money to build larger positions without spiking the price, creating. The psychology of consolidation is a grueling test of patience. During these months, the headlines will be filled with doom and gloom narratives, often citing the very sell in May fallacy we are debunking. This is a deliberate feedback loop. When the market stops making new highs every week, boredom sets in. Boredom leads to impulsive decisions. Retail investors, conditioned for instant gratification, often sell their best performing assets just before the next leg up. In 2026, the consolidation is occurring at a much higher valuation floor, meaning the risk of a deep retracement is lower than ever. The trap is thinking that because the market is quiet, it is dying. In reality, a false reversal panic is the ultimate weapon used against the retail investor. You will see sudden 5% drops in tech stocks and Bitcoin, often accompanied with coordinated media reports about the end of the bull run. But look closer at the exchange outflows and the accumulation wallets. The supply is leaving exchanges at record rates, even as prices remain stagnant. This divergence is a classic signal of a looming supply shock. If you sell based on the calendar, you are providing the liquidity that institutions need to fill their massive orders. The 2026 market is a game of high-stakes poker, where the house, the institutional elite, is betting that you haven't learned. The professional playbook for the summer of 2026 does not involve exiting the market. It involves tactical repositioning. Instead of liquidating, smart money moves into defensive growth. This means identifying companies and protocols that generate real revenue, regardless of market sentiment. High-yield assets, particularly those tied to the security of decentralized networks, become the primary focus. By shifting from high-beta speculative coins to robust yield-generating infrastructure, an investor can weather the summer chop while still capturing the upside. This is the art of staying in the game without being exposed to unnecessary ruin. Diversification isn't about owning many things, it's about owning the right things that won't all crash at the exact same time. Stablecoin parking has emerged as a sophisticated strategy for the modern investor. Rather than moving capital back into the decaying value of fiat currency, traders are utilizing high-yield stablecoin vaults to earn double-digit returns during periods of consolidation. This keeps the capital within the ecosystem, ready to be deployed the moment the breakout begins. In 2026, the yield on digital dollars often outperforms the traditional bond market, providing a powerful incentive to stay in crypto even when the charts are flat. This strategy transforms a stagnant summer into a period of aggressive capital accumulation. It allows you to profit from time itself, turning the sell in May waiting. Ultimately, the sell in May fallacy is a relic of a slower, less integrated financial age. In 2026, the convergence of institutional ETFs, sovereign reserves, and the relentless march of technological innovation has created a perpetual market cycle. While there will always be periods of consolidation and volatility, the structural floor is rising. The investors who will dominate the next decade are those who recognize that the old rules have been rewritten by code and capital. As the golden globe of the global economy continues to rotate, the opportunity lies not in walking away, but in digging deeper. Stay vigilant, stay diversified, and remember, in a world of infinite liquidity, the greatest risk is not being in the market at all.